try taking the rate of return achieved by that manager and all other like managers, and you will deduct from it the fees charged, and there are very few who, over a long period of time, do better than the market.
I came into this business when I was at Princeton, and I worked for a brokerage firm in the summer. And one of the old runners said, "Bogle, I'm going to tell you everything you need to know if you're going into the investment business." And I said, "What's that, Raymond?" And he said, "Nobody knows nothing." And that's true. We don't know what the future holds. We have all these opinions out there, and we've got to say, I'm smarter than everybody else. And that just isn't going to happen.
We can't systematically all pick the winner. So the challenge now is, okay, can I find those great active managers? In fact, I don't actually argue there are no great active managers. I'm willing to say, yeah, maybe there are some out there. My problem is I don't know how to identify who they are.
It's absolutely possible for active fund managers to beat the market and to beat the market consistently over time. But there's also the question of probability. And when you assign a probability to a fund manager beating the market consistently over time, it's very, very low.
Occasionally in the tube stations, you'll see one of those big posters with, Stellar Growth Fund, make your money reach the skies. And I laugh. I look at these and I think, yeah, right, yeah. Honestly, because these funds, they're rubbish. I mean, really, the vast majority of them are rubbish.
They will put out any product that they think the public will buy, whether the companies have any belief that that product is any good, because the idea is to gather assets. The idea is to bring in as much money as you can and manage it. And if that product fails, you could then take that money and convince the client to go into a different product that you're coming out with.
The job of a stockbroker is to transfer the wealth of the client to themselves. Typically they extract in the range of 2 or 3% of their assets per year from the clients. And if you do that over a period of 20, 30, 40 years, eventually your broker winds up with more of your assets than you do.
We all get a return from the stock market in the long run. Now, let's say for the purpose of argument that that's an 8% return. But we in the markets get the net return after the insanely high costs of financial intermediation. And those can be as much as, say, 2% a year. Wall Street, if you will, in America, gets 70% of the return and puts up none of the capital and takes none of the risk. And we get 30% of the return, we investors as a group, there's no way around this, for putting up 100% of the capital and 100% of the risk. That is just crazy.
You might be looking at 1.5% per annum or more in management fees. It doesn't sound very much, but if you're talking about an investment strategy lasting over 20 years, it's a large amount of money that you're actually paying over to the fund manager. And you want to make sure that if you are doing that, you're getting what you're paying for.
Studies are being carried out, and the FSA is very active in this, on emphasising that one of the main determinants of longer run wealth destruction is the charges. Now, people tend to underestimate the effect of, say, a 1, 2 or 3% charge each year is a very substantial reduction in the wealth.
Charges are an insidious component of the investment proposition, and for every pound that you pay out in charges is a pound that doesn't go into your pocket, which compounds over time.
Passive investing is really more about the vehicles of choice for a given investor. So it's about using index funds as opposed to trying to select active managers that may or may not ultimately best their market benchmark.
If you take a passive fund that's going to follow the FTSE 100, the person running that fund buys shares in every single one of the 100 companies within the FTSE 100. So it directly follows or replicates the index, is the jargon that's used, as opposed to an active manager who will say, I'll only pick 20 shares that I think are the best 20 in the FTSE 100. You're then relying on the skill of that fund manager to find the best 20.
Mathematics tells us that the average active investor and the average passive investor in a market where all of those investors equal the market should earn identical returns net of fees. Now, when we subtract the fees from those products, what we see is because passive funds are inherently less costly to operate, they tend to outperform active funds over time.
It has to do with the relationship between the price of a security, its risks, and its expected return. And there are really sort of two key takeaways, if you will. One is that in that setting, the most efficient strategy for an investor is to hold basically a broadly diversified portfolio reflecting the market of securities that are available. And that gave birth to the notion of index funds. And the second is that there will be a reward in higher expected return, not guaranteed, but expected, for bearing risk. But the kind of risk for which the reward should be available is the risk of doing badly in bad times.
Market efficiency is the idea that market prices adjust very quickly to new information. And theoretically, one would believe that market prices would incorporate all the known information that's available. And so if that is mostly true, which I think it is, then it's very unlikely that any investment manager or investment fund or group will be able to have the knowledge and information to consistently take advantage of market errors.
That doesn't say that other investors are stupid when they go out and hire active. What it says is if there is somebody who hires a successful active manager, there must be somebody else who's hiring an inferior active manager.
As company pension schemes become less popular, investors are forced to do it for themselves, so they need to be more and more aware that the low charges associated with, say, passive investment will ultimately, over very long periods of time, benefit them considerably relative to being with active fund managers.
So there's a return advantage to passive investing, and then I also think there's a risk advantage in that when you're investing passively, you're basically trying to capture market returns. So you are not going to be surprised by your investment manager's underperformance, or you're not going to be heavily concentrated in a few number of securities where the risk would be that if those securities do poorly, that your results will be very bad.
There's a rule in real estate that the three most important things are location, location, location. Well, my rule in investments, the three most important things are diversify, 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 and then I'll give you three more: keep costs low, keep costs low, keep costs low. And the simplest way of doing that is a very broadly diversified, very low-cost index fund.
You go overboard on active management, you will end up putting your money in too few baskets. You'll be undiversified. So you get very excited by tech stocks, or you get very excited by commodity stocks. So you put a lot of your portfolio into that. And if you do that, by concentrating your portfolio on certain areas of the market, you pick up a lot more risk than if you have a better balanced portfolio.
Depends how you sort of judge risk, but at the end of the day, you know, you don't want all your investments to be invested in the FTSE 100. Equally, people don't want to have all their wealth in the house that they own. And if you use a number of passive investments, you lower the cost of that investment to you as an investor, and cost is a big drag on investors' performance over a 10 to 20 year term.
The remarkable thing about finance is you cannot predict at all what the market is going to do tomorrow, but you can predict with reasonable accuracy what the return, at least of some asset classes, is going to be over very long periods of time. You might look at the past 10 years and say, well, it's been a lost decade. U.S. equities have had, over, depending upon the 10-year period you measure, about a zero return. But there are other things that have done quite well. Now, that doesn't mean that pattern is going to continue into the future. In fact, I can guarantee you that particular pattern won't occur into the future. It'll be a different pattern of returns. But the point is, if you own all of those asset classes, you won't screw up. You won't make up any big mistakes.
So the active path, there's always a self-doubt. I knew I should have done this. I knew I should have gone out there. There is a certain transformational experience that goes on with accepting the notion of market efficiency, which it gets to be, let's call it an aha moment, where people go, aha, that's the way markets work. And once that happens, they're much more accepting of the fact that markets go up and go down. I mean, they always have and they always will. And there's, it leads to a better overall experience. And where experience to me means more than just having better returns. It's a better lifestyle as well.
We tend to want to be in tune with the people around us because human beings are such social creatures. And again, the reason for that is evolutionary. And so when everyone else is buying, we tend to want to buy. When everyone else is selling, we want to tend to sell. And that means two things. It means that markets can be very unstable. If everybody's buying at the same time and then it turns around on a dime and everybody starts selling at the same time, you get a great deal of volatility. And then you also wind up doing the wrong thing at the wrong time.
When you have a market that's $1 trillion and they're able to scrape off $20 billion a year or 2% per year from that to feed themselves, they don't want to give that up. So there's an awful lot of marketing and a lot of convincing of the public that they need active managers, that they need to pay 2% per year. It's all about keeping the money in the pockets of the people who are creating the funds as opposed to putting the money in the pockets of the people who are taking the risk.
Quite a bit of evidence that when you're dealing with very complex issues such as investing, that the complexity is so severe that people end up just going with quick hunches. And you have a whole industry out there, the finance industry, that is built on it's built on an illusion that that there's a free lunch out there. That's what you're being sold every day in the magazines, because a magazine can't make money saying, you should be passive and do the same this year as you did last year.
We could have an article week after week after week telling people, passive investing, that's the way to go. That story gets old. There's no news here. Versus, I'm trying to write an investment story. This week, I have this really beautiful, articulate woman who's got a strategy. Next week, I've got this really handsome, outgoing, gregarious guy who has a strategy. They all make the cover of my magazine, makes it much more interesting. Versus me, put me on the cover, you're not selling anything.
Passive investing is less popular than using active managers because in many ways it seems inherently defeatist. It's almost saying, I don't possess the skills to select a superior manager, that it's impossible to beat the benchmark, so why even try? I think this almost defeatist angle really turns some people off to the idea of passive investing, because after all, we all ultimately believe that we're exceptional.
People are simply confused. Most people don't get the opportunity to hear that, active investing is clearly a negative-sum game. Just an adding up constraint, no science, just arithmetic. That's news to most people.
The trend is definitely towards more money being invested in passive as investors become aware of the fact that performance over long periods of time is very good for passive funds and the costs are very low. And a very important ingredient of a good performance is the low cost. And the research has suggested that low cost is in fact a good predictor of future performance.
I'll forecast going forward, we'll see more and more of the money invested in the UK moving toward passive. The advantages are just too strong. As people become better informed, you see more and more people saying, I'm going to give it up. I have not succeeded in the past trying to invest actively. I'm going to give up trying to do that. I'm just going to go passive where I can be sure that that I will beat the average active investor.
There will always be a large number of people who are overconfident enough, a large number of participants who are overconfident enough that they'll try to beat the market. But at the same time, the pattern that you see and the trend that you see is of increasing passive management, particularly in this country. Assets are flowing away from active managers, away from stockbrokers, and they're flowing toward companies like Vanguard. They're flowing towards advisors who manage money passively. Where does it equilibrate out? I suspect 50-50 won't be far from it.
Every time I do a new edition, the 10th just came out, I ask myself, is the hypothesis true? Do index funds outperform? And every time I do it, I find that index funds do better than about 2/3 of the actively managed funds. And then, when I look at it in the next period, I find exactly the same thing, and the 1/3 that beat the index in one period aren't the same 1/3 that beat the index in the second period.